Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvilley, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 282 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvilley, bring you everything you need to know from the past week in the world of financial markets and financial planning. So Merry Christmas and Happy New Year to you, Matt.
You as well, partner. I'm excited for 2025.
Yeah, flipping the page to another new year, so it should be exciting. How was the holidays with the family and
was great.
The kids excited with all their gifts from Santa?
I was it was definitely one of those magical holidays. It was interesting. I was on my way to church on Christmas Eve, and I make this side comment to my wife about, you might want to check the Ring camera footage. I had a little episode with Rowan, and he wasn't listening. So we're driving to church, and Rachel is like cracking up. She's like, I have to post this on social media. Mm-hmm. Okay. So she posted on her TikTok. You fast forward, it went viral. It has over 600,000 views. Yeah. People are reaching out to buy the rights to this video. So if someone could do enough
to buy the rights to the video?
They want to buy the rights to the video.
What, have they given any dollar figures
I said, let's see the number. Right. I want to see a number.
That was hilarious.
Viral Hog is one that reached out, and there was another one that wants to buy the rights to the video.
Was that on New Year's Eve?
It was on New Year's Eve.
New Year's Eve. Yeah, Kenzie showed me, and I was cracking up.
Oh, so
was hilarious.
The last 10 seconds on it, Rowan was not listening. And so I literally open up the front door, and it's the Ring camera footage, and I'm silent, and I just chuck this ball. And there was so much emphasis behind the throw. It just kept going up, and it went viral.
We'll see if we can get a piece of that and maybe share it on the YouTube video so people
there
can
you go.
see
All
it.
right.
It's worth seeing because I don't have TikTok, but Kenzie obviously does, and she showed me, and it was worth the watch because you can hear kind of Rowan being like, oh,
no, I didn't know.
I didn't know.
Oh, he got several warnings, ladies and gentlemen.
Chucks the ball out the front door, which is hilarious. Was the ball ever retrieved?
I found out he went later that day and retrieved it on his own. It was all the way in the creek.
That's hilarious.
It had some movement on that ball.
Well, that's good. Well, yeah, we were home for Christmas Day in the morning. Obviously home for Christmas Eve, which was really nice. It was just the three of us, me, Kenzie, and Mia, which was great.
Nice. Very nice.
Then went down to Florida to spend some time with my wife's side of the family, which was good.
How's the weather down there?
It was really nice, actually. It was
pleasant?
In mid to low 70s. Rained a couple of times, so we did family pictures, new family pictures. That was one of the gifts I got for my wife. So, have you ever played pickleball?
Yes.
Okay.
I'm not against it. I mean, I played tennis in high school.
Yeah.
If you remember.
So my mother-in-law's boyfriend is very into pickleball now. Mm-hmm. So let's see. It was a couple days after Christmas. Where my mother-in-law lives, they have courts. Right. So we went down to play when the girls went shopping with Mia or something like that. They think they took her to a park. So me and William go down to play pickleball, and I've played a couple of times, and I know the rules generally, but he was giving me a refresher.
And Mark is very physical. He's a guy who's definitely fit.
I would like to think so.
He's fit.
So
I think I have a feeling where I might know where this is going.
So we get down there and no one's down there. So William is like reteaching me the rules and me getting a understanding of how it's played. And then, like, we were there for 20 minutes by ourselves, and then all of a sudden, just a swarm of people come down. So, like, I guess the time to play there is between 9:30 and 11:30, and we were there at, like, 9. Right? So, and I didn't
Place to be seen.
Yeah, I guess it's, like, pickleball is very social. So, like, guys didn't even ask. They just, like, came over to our court and were like, all right, let's play a game. And I was like, oh, okay. because I was still like kind of learning and whatever. And William, God love him, he was like, Mark's just learning. Like, we're trying to teach him the rules. So I already felt like a 10-year-old, right, at this point. and these guys are all, in their, I would say, mid 60s, and not the most physically fit guys
from a first glance.
Beer bellies,
from a first glance.
So, again, I like to think I'm in pretty decent shape.
You're in very good shape.
One of the guys made the comments and alluded to, oh man, we're in trouble. We have a young guy who's in shape. And I was like, oh, well, just wait till you see this. And got my butt kicked by a bunch of 60-year-old men. And then if that wasn't bad enough, one of these people's kids or grandkids were there. His name was Nico. He was 10 years old. So after I got...
Was Nico trash talking you?
No, he wasn't trash talking me. He should have been, though, because he made me look like a crazy person out there. So if it wasn't bad enough getting beat by 60-year-olds, also got beat by a 10-year-old. So I think one of my
I love it.
One of my New Year's resolutions for 2025 is to really kind of get better at pickle.
All right, so I know we have some courts that are near us. Mm-hmm. Rachel's into it as well. We need to get the wives out there. If it's girls against guys, they're going to kill us, right?
Probably.
This is how this works.
Yeah. So there's like I was learning about the different types of equipment that you use, and there's different types of paddles that are hundreds of dollars that are a lot better than the shitty
here we go
wooden paddles.
Here
or whatever.
we go. I'm going to dump a bunch of money into this one. I can see it now.
Yeah. So yeah. Anyways, so that was fun, but I thought that was an interesting story.
That's a great story.
Very humbling.
That would be very humbling.
So
I bet that was an interesting lunch talk after that.
Yeah, it was. So anyways, we will quickly review the 2024 performance of the major market indices that we track. This data is from Y-Charts and as of the market close on December 31st. S&P 500 index up 23.3% for 2024. Dow Jones Industrial Average up 12.9% for the year. Nasdaq Composite up 28.6% for the year. The Russell 2000 Small Cap Index up 10.1% for 2024. And then the Vanguard All World Ex United States ETF up 2.3% for the year. 3-month Treasury rate ended the year at 4.37%, 2-year Treasury rate at 4.25%, and the 10-year Treasury rate at 4.58%. So back-to-back years, Matt, of pretty strong performance for stocks. Obviously, we have new administration going into the new year. We have the Fed lowering interest rates, but maybe not as many interest rate decreases as they once expected for this upcoming year. People are obviously, the big R word is coming around. Is there going to be a recession in 2025? So a lot of stuff kind of going on right now as we start this new year.
It's the things the market's not talking about that usually makes it stumble. So I want to hear people talking about the R word, right? It's when they don't. That's when my spider senses start getting raised.
Right.
That's not a bad thing in my opinion.
No, I don't think so. I think that kind of leads well into my first piece here. So moving on to tweets, articles, and research from this week. First thing I had, Matt, was a chart from Bank of America that Jenna will put up on the YouTube page in our show notes. And this first one shows the fund manager's cash allocation and how it fell to the lowest on record, which fund managers are underweight cash by 14%. So as you can see in this chart, when we talk about being underweight cash, it means we have a small cash holding, right? In layman's terms. And you can see that this exceeded the underweight positions back in January of 2002, October of 2009, and February of 2011. So in other words, people are pretty aggressively, or fund managers are pretty aggressively allocated to stocks. Now, there's a caveat that fund managers can only hold a certain percentage of their assets in cash. So that cash number is going to be low anyways, but they are on the low end of that bandwidth, it looks like. So not saying that this is anything. One could look at it, maybe say it's a contrarian indicator where, there's not a whole lot of cash out there right now. It's all put into work in the market. So what do you take away from this?
I always look at it from the aspect of where's the dry powder, right? Who's going to be, the next buyer in line? And from a manager standpoint, they're obviously very optimistic on the year, right? Because they've made their bets, they're invested. I think the individuals who have the dry powder still is your average individual investor. I would argue your average individual investor has not normalized risk tolerances because of 2022 being so near. But from a manager standpoint, the funds aren't going to be the ones that push this. I mean, they're fully allocated.
Right.
Now, what the second viewpoint I have is when you look at those previous lows, when cash was this low, January of 2002, they got it wrong. 2002, the rest of that year was poor. October 09, they got it right. The next couple of years were really good. February 2011, 2012 and 2013, for the most part, were fine. April 2020, that's when cash was high. They should have been invested. Mm-hmm. So it's interesting. I was trying to look at some of the other data points to see if I could correlate something.
It's kind of all over the board.
Kind of all over the board.
Yeah.
Yeah.
And the next piece to that is the next chart from Bank of America that shows fund managers' U.S. stock allocation. And their U.S. stock allocation is overweight by 36% and at a record high.
Welcome to the
welcome to the club. And this doesn't surprise me. And I think it would be, maybe a little concerning if they weren't that, extremely overweight to U.S. stocks, just given the performance back really since, the early 2000s of U.S. stocks that, just absolutely demolishing international stocks. And we saw that this year again, right? So what did I say? That Vanguard All-World Ex-United States ETF was only up 2.3% this year. So not as surprising to me, but just thought it was interesting to take note of.
What I'll throw out there, and I know that you definitely look at things through the lens of the chief investment officer lens. For, I would say, our regular listeners, one thing that they might not see all the time is how strong the American dollar has been. And you've talked about this internally a lot in our investment committee meetings. It's how strong the dollar's been since Trump got elected in early November. Mm-hmm. So maybe just spend 30, 60 seconds about how that dollar strength tends to affect international equities.
Yeah. So, it's funny because going back to the investment committee meeting that you were just talking about, I saw a piece of research that showed the performance of the U.S. dollar in Trump's first term, or when he first got elected, when he was president-elect in, what was that? That would have been 2015, right?
Correct.
In the fall of 2015.
Correct.
And so far, the U.S. dollar has performed pretty well. And pretty consistent with how it performed in 2015 up until this point. And, obviously with the trade war commentary and the tariffs that he wants to put into place, initially that caused the U.S. dollar to go up, right? Mm-hmm. But when we really got down to brass tacks, it was more bark than bite with Trump in his first term. Yes, were there tariffs? Yes, but it wasn't as bad as people expected. Mm-hmm. So after, the first couple of months of the dollar strength when he got elected, the dollar weakened pretty much over the rest of his term, even with the tariffs and, the quote unquote trade war. I think it was in, 2018, and where it hit the markets was December, I think, of 2018, if I'm remembering correctly. Mm-hmm. So if he kind of brings out the same playbook, we could expect the dollar to weaken, and usually when the dollar weakens, stocks tend to outperform. Now, there's been instances where stocks perform just fine when the dollar is rising as well, but usually a weakening dollar stronger for U.S. stocks. So
well said. Well said.
last thing I had was a tweet from Charlie Bolello. This was back on December 19th. Kind of a funny one, Matt. He tweeted and said, "I love the smell of mania in the morning." And it was a chart of a cryptocurrency called Fartcoin. Fartcoin, yes. That at this point in time, on the 19th of December, had a market cap of over $1 billion. So a larger market cap than a lot of publicly traded companies, right?
I have it. I'll say my opinion
right
now.
So this falls into the category of me being skeptical on where we are in this market, because we have things like Fartcoin making new highs and up 20, 30, 40, 50% within a couple of days. Like I said, I think at one point the market cap reached a level where it was a larger market cap than like 40 or 50% of stocks in the S&P 500 or something like that, which was absolutely just wild. But these are the times we live in, I guess.
I mean, I just throw it out there. Like the investment mania, the things that investors focus on come and go. And I'm not talking about the legitimacy of crypto in general. I'm going to save that topic for another day. I'm talking just about the mania of something that is relatively unknown, say, 2 months ago to an average investor, that now obviously has hit mainstream media. And anytime this tends to happen, historically, when you look at the lens, it tends to not have good outcomes.
Yeah.
And I think, our listeners and viewers can read between the tea leaves as I say that. So my message in general, anytime these types of things occur, is do your homework and very trend lightly.
Yeah, exactly. So,
good way of saying it very nicely.
Kind of a funny one to end off my things for the week. So I'll turn it over to you.
Can you imagine being at the beach? Let's just say you and I are down in Miami, right? And we're having a cocktail at the bar, waiting for the girls to come. And, Jenna sits next to me and it's like, "Oh, Jenna, tell me about your life." Made my millions in Fartcoin.
Yeah. Which I'm sure there's people out there.
I'm sure it happens.
And if anyone listens to this,
good for them,
or you're
I guess.
one of those people,
Yeah,
I'd love to talk to you.
Good for them.
Yeah.
Reach out to Jenna. We'll have you on the podcast. So, all right, my first thing is Americans are feeling very bullish about stocks. This is a post, Mark, by Unusual Whales on X. If you don't follow Unusual Whales, definitely a individual, and I would definitely follow Unusual Whales. This is on December 30th, 8:17 a.m. You're going to see, Jenna will put up this chart for our YouTube viewers. This will be in our show notes. It says the percentage of Americans expecting stock prices to rise over the coming year. The data set you're going to see, Mark, goes back to the early 90s. I'll let you interpret the data set for those listening on our traditional podcast.
Yeah, so it looks like of the people that responded to this survey, about 58% of people expect people expect stock prices to rise over the coming year, and that is way higher than average, I would say. So going back to the early 1990s, it looks like the average percentage of people expecting stocks to go higher over the next year is somewhere between 30 and 40%.
That's a good way of
saying it. Up close to 60%. So again, this makes me a little nervous from a sentiment standpoint.
Bingo.
And if you combine that with, we're at that point in the year where analysts and the forecasters are throwing out their price targets
for the end of the year,
S&P 500 for the end of the year in 2025. And most of them are thinking that stocks are going to rise pretty substantially. So I'm sitting here and I'm like, oh shit.
I know.
Is this what we're going to do this year?
Yep.
So yeah, again, we have a lot of data points that we've gone over the past couple of weeks that show, 2025 could really be just a fine year. And then there's other things that are like, hey, maybe we should watch out a little bit. Obviously, no one knows exactly how it's going to play out, but I think that there's an equal a more equal balance of pros and cons going into 2025 than there have been for the past couple of years.
Well put. And did you look at my show notes before?
No.
Okay.
Not.
So my last piece here in a couple of minutes is I have a list of topics that I think our listeners and investors should be monitoring as the 2025 year goes on. And I think it'll be very, very thought-provoking. Mm-hmm. So my next piece is an update on inflation around the world. I saw this post by a friend of the podcast, Mike Zaccardi, on December 30th. Jenna will put up this illustration on our YouTube video. This will be in our show notes. Definitely a chart I would have our traditional podcast listeners take a peek at. All of our show notes can be accessed on all of our social media sites. So whether it is Facebook, LinkedIn, Twitter, etc., they're going to be there. X, I should say. So what you're going to see here is a chart. It's inflation has cooled sharply in most economies. What it shows is core inflation, PCE, in the US, Eurozone, UK, Canada, and Australia, going back to 2019, that sharp rise mark in 2022, and then kind of where it stands today. Mm-hmm. And I think it does a good job giving a visual representation of where we stand on the inflation front. And then, of course, the source of this chart is Haver Analytics and Goldman Sachs Global Investment Research. They have a little dot plot on where they think it goes over the next couple of years. And what you're going to visually see is that after that big ramp up, we're kind of in this 2 to 3.5% range, depending upon the economy. Your thoughts, comments?
Yeah. Again, a major forecast that no one really knows what happens, and it gets dependent on a couple of things. I think, obviously, wait and see what happens with Trump administration's potential tariffs, which some people are saying that's going to cause another inflation firestorm. TBD on that. The Fed keeping rates higher than investors initially anticipated for 2025 because maybe they see something in the data that's like, hey, maybe we're not done with inflation reigniting or not. So I don't know. It could be interesting, but I will say this. When it comes to inflation or when it comes to interest rates, I think what the Fed did at their last announcement in December and how the market reacted, the market was disappointed that there weren't going to be more rate cuts in 2025. And I think there's a really interesting opportunity because everyone now is in the mindset or prepping for potentially higher inflation, I think, this year and higher interest rates. And if we don't get higher inflation, if inflation keeps trending downward, I think the market has a really good opportunity to surprise again to the upside when everybody thinks that the opposite is going to happen. Yeah. So I would watch out for that. If inflation does keep on cooling, I think, markets could surprise to the upside because it's baked in that inflation is going to rise a little bit this year.
Well said. Well said. I'm on a similar wavelength here in a second when I go over my things to watch this year. So I will be referencing that comment here in a second for our listeners and viewers. Good point. The next thing I got is, where does the U.S. stand in regards to debt to GDP? So I know that, over the decades, our listeners and viewers in their everyday life are listening to the news, and I know this term comes up, debt to GDP, right? And it is a term that is used to, in essence, reference the amount of debt that a sovereign nation has relative to its annual economic output. And it tends to be utilized, I think, as just a data point or a marker, okay? So this chart I ran across was in the JP Morgan Investment Outlook for 2025. So Jenna will put up this chart for our YouTube viewers. This will, of course, be in our show notes. And Mark, the data set goes back to the 1940s. And you're going to see that, after World War II, the debt to GDP got up to a little bit over 100% of debt to GDP. And then
meaning that the country has more debt than the output
on an annual basis.
On an annual basis, yeah.
And then that got down to the 40% range on average in the 50s, 60s, 70s, and 80s. And then since the mid-2000s has been rising pretty continually. And what this is showing right now is that debt to GDP right now is right back at 100% roughly. Okay. And we can set the forecast aside. Obviously, the trend is that I thought no matter who won the election in November, he or she was going to continue deficit spending.
Yeah.
There's no way around it.
Right.
Now, I'll be very curious to see with the incoming administration, if they do try to cut cost, what that looks like. But let's face it, they're probably still going to do deficit spending. And my concern is, you continue at this pace. It's not maybe as much of a concern the next couple of years, but longer term, eventually you got to pay the piper. Yeah. And one could sit there and say, well, if they start, raising the economic output of the country, it changes that debt to GDP percentage. But it definitely is getting to, okay, we're back to 100%. And I don't think a lot of people know this. And I wanted to share this chart. Your thoughts, comments?
Yeah, we've gone back and forth, me and you, several times on this topic about just having the conversation of at what point does the debt matter, right? At least to the markets,
sure.
Right? And like you said, the debt to GDP has been rising very steadily since the early mid 2000s, and things have kind of been just fine.
Yeah. And a lot of that was fueled at low rates too.
Right. Yeah. And that's the other thing. I think I have a piece slated for next week, I think, that shows the amount of debt that's coming due or just came due that needs to be refinanced at higher rates for the U.S. government, which is not a good thing. So obviously, the government, with the way they're spending, lower interest rates are in their favor. So that's going to, cause the spending to just increase more, and the percentage of that spending is going to be, a higher percentage of it is going to be the interest rate payments, right? So yeah, I don't, just like anyone else, I don't know when this becomes a problem. I think it will eventually, but maybe that's not until it's 200% of GDP.
Correct.
Right?
I mean, there are developed nations out there. Japan's the worst offender on this specific topic.
Which I don't think we want to be Japan, but
just to give people a marker point, they're well above 200% debt to GDP.
Yeah.
Completely different underlying economic dynamics of the way that their average citizen saves and et cetera. All right. So my next topic is just some important things that I think investors should be monitoring as 2025 goes on throughout the year. This list of items is not completely all-inclusive, and it is not in any priority order, just some things that are top of mind. So I'm going to go through them. First is the 10-year yield. So the yield on the 10-year Treasury bonds have increased 100 basis points. That's 1% higher since the Fed made its first rate cut just in September. That is not normal. The Fed has cut the Fed funds rate by 100 basis points since then. I personally really don't want to see this go over 5%. The highest it got in recent history was 4.997% on October 23rd. So I'm going to throw it out there. It goes back to the affordability of what the government can do on refinancing this debt, right? And feel free just to, hey, I have a point. I'm going to keep going till you tell me. Sound fair?
Yeah.
Okay.
Yep.
Next, how will the dust settle regarding the incoming administration's plan to lower income taxes and raise consumption taxes, i.e. tariffs, along that same wavelength mark? How much will a lower corporate tax rate and lower regulations inflate or make corporate earnings rise? And how much of that is already priced in to stocks? Next, earnings season. Especially with forecasting related to the incoming administration's changes. Earnings season is every quarter for our new listeners. For example, fourth quarter 2024 earnings will be released for a majority of companies around the end of this month in January, beginning of February. Rinse and repeat every quarter. I think there starts to be more of an emphasis on earnings season and companies forecasting how the new administration or congressional changes, say to the tax code or regulation, how that's going to affect their earnings. I think that's going to be something that's monitored.
I would agree with that. I think since 2020, a lot of it has been focused on a lot of the market and a lot of earnings have been focused on like inflation. And I think we're starting to get back to
brass tacks, baby.
brass tacks and really focusing on the earnings of these companies and not having these CEOs, CFOs, CIOs talk about inflation all the time and blaming everything on inflation.
Yes.
So,
Well said. That's a great viewpoint. Next, how much of a pickup we'll see in merger and acquisitions under the new administration? Are we going to see a flurry of purchasing of small and mid-cap companies? Next, will AI spending continue at a rapid pace? It seems to be a big portion of S&P earnings growth depends on it. Next, the dollar has strengthened since Trump won the election. Will the dollar continue its strength post-inauguration, or will it sell off like it did in Trump's last presidency? You've talked about this, Mark, in our internal meetings. You just talked about it on the podcast a little bit ago. Historically, a strong dollar puts pressure on global equities. Next, overall state of the American consumer. I'm talking income. I'm talking their spending habits. I'm talking their sentiment. So rather than being a traditional investment bank and coming on the podcast from my standpoint and saying, these are my bold predictions for 2025, I wanted to come at it from this wavelength for our listeners and viewers and say, these are some of the topics that I think the market is going to be putting an importance or emphasis on. And I wanted to highlight some of those. Again, it's not all inclusive, and I'm not necessarily coming at it with dramatic, bold predictions, but rather here are some of the things I think the market is going to be focused on. That's how I wanted to kind of kick off the year.
yeah, no, it's great. It's a good list of things, and I think we'll get some answers on some of these things within the first half of the year. Again, we're not in the predictions or forecasting business, but with the current data that we have, I'll just throw it out there. It doesn't really seem like a recession is going to happen in the first half of 2025. Could be completely wrong on that. But usually when we're going into a recessionary period, rates are coming down, and I mean like rates on U.S. government debt, right? And they're not, right? The Fed is lowering rates, the Fed funds rate, but rates in other places are still going up, which doesn't really coincide with what we've traditionally seen during recessionary periods. So yeah, it's like any other year. It's going to have its ups and downs and pullbacks. If I were a betting man, I would say we'd get more volatility this year than we have the past 2 years. I think
I could argue that too, yeah.
For 2 years in a row, specifically in 2024, I think the largest pullback or drawdown was 9%, almost 10% maybe. And usually, we get a couple of those and some even larger than that. So I would try to prepare people for expecting some expansion of volatility, some larger pullbacks. Not saying that the market's not going to recover from that, but I think we should expect that at this point.
Well said. Even in my one-on-one client review meetings, I've told clients over the past 3-4 months, hey, I might catch you in one of those corrections next year, and 2025 doesn't make it a bad year. I just might catch you in April or March or June, and we just had a 10% pullback. Very much likely expect that to happen.
Yeah, for sure.
Before we transition to our financial planning topic of the week with Taylor Ledbetter, Mark, any final comments to kick off the year for our listeners and viewers?
Nope, I don't think so. I think I've said all I wanted to today. So hope everyone has a happy new year, and hopefully we get off to a nice start here in 2025.
Great podcast, my friend. All right, we're going to transition to our financial planning topic of the week. Taylor Ledbetter heads up our financial planning aspects and activities for the firm. She has a popular blog on our website, Tailored Finance. You can find that at jessupwealthmanagement.com. Her blog, I know it is popular. Taylor, welcome to the podcast.
Good to be back.
So how was your Christmas and New Year's this year for you?
It was good. Just spent a lot of time with family. Luckily, a lot of my family lives 5 minutes away.
That's so nice.
Yeah, I couldn't imagine traveling far during the holidays.
Yeah, you hear the stories, right? And you hear all the horror stories typically. And what a big blessing. So was it nice?
Mm-hmm.
Good.
Yeah. Christmas Day, we went to 3 different Christmases, so
You could pull it off.
very busy. Yeah,
And you could pull it off. Well, that's great. That's great. You excited for the new year?
I am.
Good.
Yeah. It was good to have a little bit of time off, but it was a good reset, and it's definitely nice to be back at work.
Any kind of resolutions? You got Mark saying he wants to be better at pickleball. You have anything you want to throw out there?
Honestly, I'm not a huge resolution person.
I'm not either. I'm not either. So I think you and I are similar in that then.
Yeah, maybe just like the normal stuff. Should probably go to the gym more.
A little more
Should probably
discipline
eat
in
better.
general.
Yeah.
There you go. You know what's funny? Before I turn it over to you, I'm sitting at church on this past Sunday, and the pastor says, does everyone know the second Friday of January is known as Quitters Friday? I did not know this. And he says that, all of a sudden people start going to the gym. And, people that have been at that gym for a long time are like, okay, it's going to be a little harder to get this machine. But I guess the rumor mill at these places is you wait 2 weeks and a majority of the New Year's resolutions fall by the wayside. And it happens by the second Friday of the new year. I have never heard of this term before. Have you?
I have not, but I do believe
second
it. That's
Friday, Quitters
interesting.
Friday. I've never heard that before.
I haven't either. You probably have to work maybe in a gym or
Yeah,
something
to really
hear
get
that.
some idea of that. But
Yeah.
So we'll turn it over to you. I know you always come up with great content that is relevant. So Taylor, what do you got this week?
Yeah, so you may have heard some talk in the news about another $1,400 stimulus check.
I did, but I don't know anything about it.
That's what I'm going to be talking about
All
today.
right, perfect.
So I'm going to be referencing an article. It's by Kelly Taylor.
Okay.
I got this from Kiplinger.com.
Okay.
So it first starts out talking about something called the Recovery Rebate Tax Credit.
Okay.
So this recovery rebate credit was part of the government's response to COVID-19.
Okay.
It was a refundable tax credit that was linked to the stimulus checks that people got back in, I think, 2020 was when those hit.
Sounds about right.
So basically, eligible individuals who did not get the full amount of their stimulus payment or whose circumstance changed could claim this recovery rebate credit on their 2021 tax return.
Okay.
However, many people didn't know about this credit just due to lack of awareness about eligibility. So that's why the IRS, they're now deciding to issue these $1,400 stimulus checks out.
Interesting. Okay.
So these payments are supposed to be processed by late January of 2025, either through direct deposit or you might receive a check in the mail. It really just depends on what or when you provided your 2023 return.
Okay.
If you have closed a bank account since filing your 2023 return, you'll just receive a check to your address on file to the IRS.
Yep. Probably wherever address you put in your last tax return, I would assume, right?
Correct. Yes. And I do know everyone should have like a profile through the IRS's website.
Yes.
I do know it should say if you're eligible for the stimulus check on your profile as well.
Interesting.
That's probably the easiest way just to see if you're eligible.
I'd be surprised how many people have those profiles, Taylor, because I have one as an example, right? I just don't know how many people are active with that.
My guess is not very many.
Yeah, I think they should be, though. I think they should be.
Yeah, no, I
glad you brought that up.
agree. Yeah, so essentially the people who are eligible is if you didn't receive a stimulus check maybe that first time around.
Got it.
And you didn't fill out anything regarding this recovery rebate credit on your 2021 tax return. So the article also just says taxpayers who have not yet filed their 2021 taxes, you might still receive a refund if you file or claim this recovery rebate credit by April 15th of 2025, even if income earned from a job, business, or other source was minimal or non-existent. So yeah, if you are eligible, these payments should be hitting within the next month or so.
That's neat. And what's really cool is you mentioned if they don't have an account with the irs.gov, that they could potentially make one of those, and it would also kind of communicate their eligibility on this topic, which I think is really cool.
Yeah, because I think a lot of people, even if they didn't receive the stimulus check, they're probably not going to remember if they filled out the recovery rebate credit section.
That's right.
On a return from 3 years ago.
Yeah, life is busy. It was the middle of a pandemic. I mean, it's a lot to recall, right?
Yeah. So the fastest way would probably just be going to your IRS profile, which, like you said, you should have anyway.
Yeah, I love that. That's great, Taylor. Good topic for the week.
Yeah.
So we'll kind of transition. I want to talk about, podcast in general. We use Blueberry to host our podcast, and that is spelled BLUBRRY. If you want to create your own podcast, you can use promo code Jessup Wealth to get your first month of Blueberry podcast hosting for free. You can choose the ideal plan for you using their hosting estimator on their website. Again, you can receive your first month with promo code Jessup Wealth, all lowercase, no spaces. In addition, I know Jenna uses Firefly's AI software to help summarize our podcast in text form. So if you're looking for a piece of AI software to help you note take and summarize a meeting, we highly recommend Firefly's AI software. You can use the link in our show notes below to purchase your subscription and make life a little bit easier. I know we got Mark's final thoughts a couple minutes ago. Taylor, I will give you the honor before we sign off. Any final thoughts, comments about going into the new year here?
Yeah, I mean, I do think it's going to be a good year. I agree with everything that you and Mark were saying earlier. Kind of looking forward to seeing what the new administration does regarding tax rates and regulations. So that will be really interesting this year.
It really will. And I think this will be, at least in the beginning of the administration, this is definitely going to be one where I might be listening to more of their press conferences, because I think they're going to do a good job, hopefully, in kind of previewing what these are. And I think not only me, but a lot of market participants are going to be watching those press conferences, at least in the beginning, a little closer than normal. So, thank you for listening to episode 282 of the Independent Advisors Podcast. We'll be back with you next week for episode 283. Myself, Mark, Jenna, Taylor, Aaron, Nick, all of us that are a part of the podcast here at Jessup Wealth Management appreciate our listeners, and we look forward to delivering some great content in 2025.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.